Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Welcome to the Stock Play of the Day. Today's stock is McKesson. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist at Ally Invest.
Well, hello, Lindsey. I see that we have kind of a mixed marketplace going on today. What do you see going on in the markets this week?
Yeah, this Monday morning isn't green like the last several Monday mornings that you and I have experienced together on the back of vaccine news. So we did get confirmation from Moderna this morning about the efficacy of their vaccine being in that 94% range, which is really high and really great news, but kind of was expected. Unfortunately, this morning, the S&P 500, Dow, NASDAQ, Russell 2000, they are all in the red. We're looking at a chart right now, the S&P 500, Brian, you and I, we've been looking at that top line, that red flat line that we drew on there several weeks, if not months ago. That takes us back to the September high. And as you can see over on the right-hand side of the chart, we've just been bouncing around that line for the last several weeks here. What is that at? 35.88. We're above it right now. We'll be watching that number as the day progresses because the market's been losing some steam from this morning. But we have to take it all in context, right? This is the last trading day of November. And guess what? The S&P 500 going into this morning was up 11.3% in the month of November. That's a huge, that's just really impressive performance for the month of November. And you know, the Santa Claus showing that the Santa Claus rally is off to a really good start. Obviously, that pop in November has been driven by a lot of the vaccine news that we've seen, but also the fact that we've gotten past a lot of the election uncertainty that was out there. So we all know the markets don't like uncertainty. So that is one thing that has been removed. I mean, last week too, the market was up 2.3%. That's the S&P 500. So taking a little bit of a breather, a pullback here makes sense. Coronavirus cases continue to rise, hospitalizations continue to rise. So there is that worry out there, even though we are hopeful that we're going to get past this at some point in the future. Though there's Fauci, I think, was out there Sunday, Brian, talking about how there might have to be specific restrictions put in place for holiday travel, given where we're at with regards to the virus. Some other news out this morning too, by the way, it's going to be a kind of a quiet data week. At the end of the week, though, we do get that jobs number for the month of November, and that's going to be really important. All eyes on that, seeing if the unemployment rate can stay in that, I think, 6.9% range, maybe come down. See how many jobs were added in the month of November when coronavirus cases were rising. So it'll be important to watch out, watching wage growth too. But also this morning, we heard some news really when the market started moving a lot lower. It came under serious pressure when there was an article out from Reuters that reported that the Trump administration is putting more pressure on China before it passes the baton to President-elect Joe Biden. He's saying that he's going to put Chinese chip maker SMIC and the national offshore oil and gas producer, China National Offshore Oil Corp, or CNOOC, on the restricted list or blacklisting those guys. So sending a strong signal and increasing our tough stance on China going into the end of the year. So that, I think, is part of what drove the market a little bit lower this morning. But you know, it's also going to be a volatile day, Brian, because the MSCI is rebalancing all their indices at the end of the day, right at the close. We do see, if you have a chart of the VIX, I think you do, the VIX is up this morning with all the major indices down in the 21 range last I saw. And so, kind of, elevated, but down from where we were a couple months ago. So, Brian, what do you make of the volatility as we go into the last month of the year?
Right. Okay. So the VIX is always it's an interesting thing in that whenever we see the markets going down, we seem to see the VIX running up. And when the markets are going up, we kind of have the VIX just kind of trickle down. So we touched the 20 line, and we've been talking about it breaking down below. That when we're setting all-time highs in the VIX, this 20 line, if I go all the way back to before the March downturn, that was basically the high in the VIX that we had for the year. Now we're kind of come back to that. And we actually touched that line, but we haven't broken below it. And to me, I think that's kind of the line in the sand about where the fear mongering is in this marketplace. And you were talking about the end of the month, Lindsey. I wanted to also highlight on the chart. I switched over here. See, look at this big green candle that we had in November. That's a really solid, this is a monthly chart that we're looking at. And so basically this might change a little bit tomorrow, but that's a very solid candle, just showing you how strong we were in March. But yet we still see the VIX up above 20 and going out to February or going out to December, January, February of next year, we're still seeing that VIX hang in that 25% range. So there's still a lot of fear in the marketplace, even though we keep setting new highs. Now, the contrary point to this, and you might have mentioned it a little bit here, Lindsey, we've talked about it a lot over the last couple of shows, is that the Russell 2000 index is driving the markets higher. It's actually leading the way. So you're having the small caps outperforming the large caps in this marketplace. And that's usually a good sign overall, especially when you're worried about recession concerns, even though we never got the stimulus package. The stimulus package would have helped out the small caps more so, you would think, than the large caps. But yet the market continues to go higher in the small cap indexes. So with that said, let's get into today's stock. McKesson right now is trading up, about flat. It was up a little bit when we started, but I think now it's a little bit more flat. What are we seeing there, Lindsey?
Yeah, before I dive in, just a reminder to our viewers that we will take your questions at the end of the show. We'll say 5 or 10 minutes. So be sure to type in your questions on the right-hand side in the chat box on YouTube, and we'll get to as many as we can. But yeah, let's talk about McKesson, Brian. We've been kind of in this healthcare phase. We've been looking at a couple different types of healthcare stocks, the sector in general. And today we're looking at McKesson. McKesson is a drug distributor. And these guys, looking at stock here, we always talk about this. We've seen a big pop at the beginning of November. It is up. It popped 20% actually from the evening of November 2nd to that green bar that you got there, that recent high in the middle there. And it since has come down and back up. So been a little bit volatile. Early November 3rd, these guys reported earnings, and it was a great report. They beat on the top and bottom lines. That was really driven by the pharmaceutical segment, which is their largest segment, weighing it in for the quarter at $48.1 billion in sales. So definitely nothing to be scoffed at. These guys are one of 3 largest drug distributors in the country. Not only did they beat expectations, they were able to raise guidance for the full year. So they just reported their fiscal second quarter, which ended September 30th. So for their fiscal year 2021, which will end in March, they raised guidance by 15% at the midpoint. That's a pretty big uptick, a pretty big increase. So investors obviously cheered that news. They also cheered the news that right around the same time came out some clarity about the opioid litigation that's going on. These guys, just like some of the J&Js we've talked about in the past and others have been involved in, they're getting close to reaching a settlement where they may be paying $8 billion over several years. So just the fact that it hasn't been set in stone yet, and there's still some negotiating that could go on, but the fact that there is a number, there's kind of a game plan around that, I think also provided some relief to investors as they think about the future, and the company's able to now put a liability on their balance sheet and plan for it going forward. So that was just in a sense a positive for the company and the forward looking stance of investors. So we've got that going on. But another reason that this stock kind of caught our eye was because obviously we talk about every Monday what's going on with the coronavirus crisis. And as a distributor of drugs, these guys have been selected to partner with the CDC to help plan for the distribution of the coronavirus vaccine. So the CDC is controlling the whole aspect of it. They're determining everything from who gets the vaccine, when they get it, how many doses they get, et cetera, when and where to ship it. And they're going to partner with them. And the reason McKesson is interesting is because McKesson has a lot of experience with this type of distribution. If you remember back in 2009, Brian, the H1N1 virus, the public health crisis we had then, they played a key role in the distribution of the drugs to address that crisis. And they also are the largest seasonal flu vaccine distributor every year. So these guys have a little bit of experience in this type of thing. And this has been one of the biggest concerns, I think, for the marketplace, was not only manufacturing these vaccines and other drug treatments, but then distributing it. And McKesson's going to play a key role in that. And the CDC's vote in choosing them has obviously been a vote of confidence in the company in general. Of course, there's only three major drug distributors in the country, AmerisourceBergen and Cardinal Health being the other two. But this is just an interesting play if you're looking for continue to look for ways to benefit from the coronavirus, stocks that are going to benefit from the drugs and the distribution. These guys can certainly be one of them, but it's also long-term defensive play too, especially as uncertainties like around the opioid crisis evolve. They're doing a lot of things to improve their profitability. And so they're spending some money now to prepare for that. They're actually spending money on distribution, or building facilities to prepare for the distribution of these vaccines. They're hiring people. So they're spending money, they're putting money behind the distribution of these vaccines, which is a very good thing for the country in general. Also, from even as they're spending, took a look at their balance sheet. They've been paying a dividend. It's only about 1%, but that's a little bit of something, a little kicker to the stock for you. Not quite as high as the S&P 500, but they're part of the healthcare sector. Their debt to EBITDA has come down in the last year, standing at 1.5 times versus about 2.4 times last year. So even while they're spending, they're seeing their profits improve. They're cutting expenses, and they're able to improve that ratio as well. And then finally, I'll talk about, Brian, I always look at valuation of these stocks. McKesson's trading at about 10.8 times. The 10-year average for this stock is 13 times. That's less than the healthcare sector, trading at 17 times now. So from a valuation perspective, it still looks pretty attractive despite that run. I think that, these guys, like I said, they're likely to benefit from the distribution of the vaccines, likely to continue to be a high quality defensive play in this environment that is likely to remain volatile until we get better clarity on what the vaccine and stimulus is going to look like. I think those are going to be the two key drivers over the next couple months. It might be hard for us, Brian, to get out of that range that we've been in for the S&P 500 while we wait for some of the bigger, broader news. But so this could be something to hold you over until we get really out of the woods here. But so what would you do from an options trade perspective? What kind of strategies are you looking at today with McKesson?
Right. Well, I'm going to start by just looking at the chart today. Right here, this little area, you could almost draw, this is an interesting area on the chart in that hopefully we'll get a little bit of support. We're up a little bit today. And obviously the highs up here right around 187. I'm actually going to do a long call spread that's going to straddle these prices. We'll go a little bit in the money here, buy an option contract down at this level. It'll be a call option. And then we're going to sell one right up around 85. So it's going to be a little bit more of a short term, looking for some speculation to the upside. There's potential for good news that could come out at any time. But then again, you never know with news exactly what could happen. But all the things that you highlighted when you just talked about the company, the distribution, things that need to, what's going to happen going forward as we get into the new year, and all of the vaccines that are coming out. The one thing that's really interesting about MCK is that it doesn't really matter what company has the vaccine that ultimately gets sent all the way across the world. They're going to be involved in it in some way, shape, or form. So it's not a race to figure out which company is going to have the best vaccine and can actually pump out doses of it as quickly as possible. McKesson is going to be all across the board on whichever company it is. So in the short term, we're just going to look at a more speculative trade, just a long call spread. We kind of did something like this in Johnson & Johnson last week, but we went out a little bit longer in time. This is going to be a little bit more of a short-term trade. So what we're going to be doing is buying strike A, a little bit in the money. And I should say this is the Ally Invest options playbook. We'll be going a little bit in the money, buying strike A, and going out about 18 days in time. And then we're going to sell strike B. That's going to be a little bit out of the money. So we're going to take some of this volatility premium out by doing this long call spread. And we're hoping for a pop to that high that was set recently to the upside. So how does that look? Let's get into the Ally Invest option chains. One thing that's also nice about this stock is that they never did cut their dividend. They got a fairly decent dividend overall relative to the rest of the marketplace, 42-cent dividend. Earnings date already happened. That was the driver to the upside on the stock back in November at the beginning of the month. We are up about 0.5% today. So that's a good thing overall as far as the chart is concerned. We'd like to stay above that little support level, and hopefully that'll allow us to get to the upside. So we're going to go at 18 days in time. That is the normal monthly expiration. I prefer to stay in that expiration because usually you're going to have higher open interest, higher volumes overall. Market's a little bit wide in this underlying, so doing a spread kind of helps with that, but it's not too shabby. We do have some open interest, some volume. We're going to be buying the 177.5 strike call, that expiration, and at the same time selling the 185 strike call, which is basically where the new high was at, right in that range. So that's what we're targeting. And if we do this, we would do this all as one trade, and this would be the official paper trade. And I always emphasize, we're just trying to learn here on Stock Play of the Day. It's not meant to be a recommendation overall, but we are kind of managing our risk by doing this trade. We're going to be paying at the midpoint, 380, if we could fill somewhere at the midpoint. Never a guarantee, but that's where you want to focus your thoughts and your order when you're placing it. And that means we have a 7.5 point wide spread, and we're paying 380 for it. So we have more upside than downside overall, but it's still $380 is still a little bit more expensive on a speculative trade, like compared to Johnson & Johnson last week that we talked about. We did a butterfly and we lowered our cost all the way down to $1. So in this instance, I would definitely want to manage my risk. If I'm paying 380 for it, if I lose about half of that. So if I saw this long call spread trading for, let's say 175 or somewhere in that range, I'm going to probably close it and get out. But I still want to get that upside. So I want to see this trade for about $6 or maybe even $7 on the upside. That's going to be a target. If I entered this trade, as soon as I got done, I would put my target to the upside, right? Let's call it 6.5. Let's put it right there, leave it good till canceled, and that would be our goal on the upside. So let's make this the official paper trade by putting it in the right rail of the Ally Invest option chains here. And let's review the trade. So here's what we're doing. We're buying to open the December 18th expiration, 177.50 call, selling to open that same expiration, 185 call. Hopefully we're getting it done somewhere around $3.80. That means our total risk on this trade would be $380 plus commission. And if we run down to the profit and loss graph here, this kind of highlights when you first put on a long call spread, your profit and loss graph changes immensely as the expiration approaches, especially when you're dealing with fairly volatile underlines, because you're selling this 185 strike call that really wants the market to go down, but you're buying a more in the money, more expensive strike call, and that wants the market to go up. So as time passes and you are correct on your forecast, hopefully, this line will eventually look a lot like it does at the expiration date. And how can we show that? Let's go and remove the days to expiration from 18 days. We'll go all the way down to 2 days and we'll regraph it. And now you see the colored line start to morph into the actual profit and loss graph. So when you're picking long call spreads, picking the duration is much more important than just buying a call outright. If I buy a call outright, it's okay to err with too much time. When you're looking at a long call spread, I usually like to do them a couple of weeks out, looking for a little bit of a pop to the upside, maybe hit that all-time high that was established just a few weeks ago, actually, in MCK. All right, so this is the profit and loss graph, and we got here's the overall trade. Looking to do it for $3.80, and that's going to be it for the option trade for today's stock play of the day. Let's now get to some of your questions, if we have any in the chat box. I see we have a few, Lindsey.
Yeah, we're kind of quiet today, but our buddy.
A little bit. Well, a long weekend. They're still getting over the turkey, I guess.
I know, turkey. I ate too much of it. I'm a little tired today too. But hey, Wayne, can you explain? He asked how we use a company's PE, price to earnings, to help us evaluate if a stock price is undervalued, fair valued, or expensive. This is something I always look at when I'm looking at a stock because it tells you what the price is what the stock price is compared to its earnings or profitability. And I always look at the forward 12-month estimate. And what I typically do when I look at a stock is I like to graph the history of it. We have S&P Capital IQ data that we use to be able to do that. And I look at where it is today versus where it was over the last 5 or 10 years. So I compare that to its historical average. So for McKesson, I mentioned that it was trading at 10.8 times on a forward 12-month basis, and its 10-year average was 13 times. So that's below its 10-year average. So anything below a 10-year average is suggested it's trading at a discount, and there could be opportunity. But sometimes things trade at a discount for a reason, because there is an opportunity. There was more opportunity in the past than there is now or in the future. But most times it's an indicator of where the market is pricing things. And also sometimes I look at the PE of a stock versus its sector. And you can also look at the history of that trend as well on some of these data sites. But in general, if you can just find the PE, the history of the PE of the individual company, that's a good place to start too. It's just one thing to look at when considering investing in securities. So that's what I typically look at. I don't know, Brian, you have anything to add there?
No, I'm actually answering the next question right now, Lindsey, as we speak. Somebody was asking about the midday market call for tomorrow, and I just wanted to put that link in. But no, I think PE is a great example. That's one of the reasons why this stock is interesting today, is that it has a good PE ratio relative to the market, and just let you know where that underlying stock is relative to its peers. And MCK is trading at a solid PE. Some could say a little bit undervalued compared to the rest of the market overall. All right, and then we had another question that was talking about the midday call, which is my show that I do every Tuesday here on Ally Invest webinar platform, which is WebEx, and I put that link in there. And then next question, what do we have there, Lindsey?
Yeah, I don't see the link you put in there. Where'd you put the link?
I threw it in the chat box from that link right there. That's from Brian W.
Okay. For some reason, it's not popping up on my screen, but maybe I'm behind. Ramen AR, what is the fate for Chinese stocks? That's
That's
a
a
pretty
tough
big
one.
question there.
Yeah. Oh, do we got a
I
couple
don't
of
think
hours?
yeah, I don't think we have a short answer for you. I mean, it's going to, I think we're going to have to pass on that one. I'm sorry. I don't think we have a clear answer, right, Brian?
Oh yeah, that's just a tough one, and it's something that we don't really know. It's changed. The story's changing every day. Obviously, this administration is going to battle with China, and it's that simple. So unless you know what's in the administration's head going forward, it's really hard to tell exactly what's going to happen with all these stocks.
All right. Yeah, I think that's a fair way to put it. We do have another question from Kaimana Kimi. You mentioned the current PE of 10 compared to historical PE of 13. Is a discount at what point does the PE become a concern? When you start to get significantly away from that historical number. So once the PE, the current PE crosses 13 in the case of McKesson, it can go above it and that could be totally fine. But the further stretched and away you get from and above 13, the more concerning it can be, unless they have significant growth initiatives that are going to drive earnings much higher or sales much higher, then you can accept a much higher multiple. But usually when you get stretched from that historical average is where you want to start taking a deeper dive. Letitia says she doesn't see the link. Right.
Okay. I'm trying.
Couple people.
Letitia, how about you just send me an email? theoptionsguy@invest.ally.com. Theoptionsguy@invest.ally.com. I know that's a long one. I'm not quite sure. Did it pop up yet? I keep redoing it. That's just not going.
Yeah, I don't see it, but
all right. Well, I'll take.
We got another question though from Wayne. Brian, since we're only doing 18 days, would a deeper in the money delta be better with more intrinsic value, like buying 175 and selling the 182.50?
Yes, overall, and it's not necessarily a yes. Why did I pick the strikes that I picked? Let me change that up just a little bit there. And it had a little bit to do with the chart. We're looking at the potential for the underlying to get to 185. If you go down and do the 175 strike and keep the widths the same, in that instance, you're going to be paying more for that trade. And if I'm doing a long call spread that's a little bit more speculative, I want to have the potential to get more upside on the trade than downside. So we're paying 380 here, and the entire trade is going. The width of the spread is $3 or $7.50. If we go down a little bit more, you're going to have to pay more, and that means that's going to limit your upside overall on the trade. So that's part of the reason why I picked the strikes that I did. But you're always paying attention to the actual time value. And if you did the 175 selling the 182.50, that's okay. That's not that bad of a trade overall. You're going to be selling a little bit more time premium than you're buying still. And so that's a good scenario if you're looking for just a little bit more of a short-term pop. I don't mind that trade, but because we were thinking that it might be able to get up to 185 based off of what the chart is, I would rather do the other strikes and lower the overall cost, hence lowering the overall risk of the trade. But that's a solid question overall. Now, once again, not meant to be a recommendation. We're just trying to understand exactly why we picked the expiration that we did and why we do the width of the spread that we chose here too.
All right. Well, I think that's going to do it, Brian. That's all the questions that we have today. And we're coming up at the end of the show anyway. So I think we're going to have to call it a show. But I'll remind everyone to tune in on Friday at noon because Brian's going to review this exact trade and determine if there's any adjustments that could potentially be made at that point in time after we get through the rest of the week and head into the weekend, how you can think about it then. So be sure to tune in at noon on Friday and right here on our Ally YouTube channel. Brian will be here waiting for you.
Yep. Click subscribe, ring the bell. You get all the alerts. We'll see you this Friday. Thanks for coming, everyone.